This to me is the biggest dynamic for the company for an investor to understand. Warner, Sony, Universal, oligopoly of record labels. And it's been that way for a long period of time. That makes it really tough for Spotify to negotiate with them.
Welcome to Alpha Bets, a weekly conversation where we dissect interesting companies and help you understand the investment thesis in about 12 minutes. I'm joined today by Ross Klein, the CIO of ChangeBridge Capital, Pat Connolly, our resident stock detective, and special guest Uday, author of The Atomic Investor. I'm Nathan Warden, and it's time to talk Spotify. What are the two battles that Spotify is constantly fighting?
Spotify is constantly fighting the classic supplier versus distributor battle. Who has more leverage? The music labels or Spotify? And then they're constantly fighting a battle from big tech, Apple, Amazon, Google, who also have music themselves, who include it in larger bundles. Like you want media, Apple can give you music for free. You want free shipping, Amazon can give you music for free. This is a really tough value proposition to maintain from Spotify's angle, but they're doing it.
It has a new battle on its hands recently with the controversy with the Joe Rogan podcast. I think that's turning out to be quite interesting. We'll see how the management responds to that.
Should investors be worried about the Joe Rogan effect with Spotify?
I don't think they should be worried about it. I think short term, it's definitely publicity where people are saying they're going to take the music off the platform. Some people are going to cancel subscriptions, but there are a lot of people who are going to be introduced to the podcast. And there's a lot of people who are going to dig their heels in deeper and support Spotify deeper. So it could be net negative, net positive, but really I think it's a nothing story.
Yeah, I think it's a little early for us to know what sort of impact it might have, but the company's responded pretty flawlessly. They got Joe Rogan to apologize. They're actually doing a really good job of transitioning into lesser known artists where this is much less of an issue. There's been an argument for years that Joe Rogan is like the equivalent of a too big to fail bank. I don't know that that's necessarily fair. Spotify is still in control of the situation in that they could, in theory, pull his content. They have pulled content in the past. This is really nothing all that new. It's just much more publicized because it's a well-known artist who's going out and saying it's me or him. But the company's responded. They've spoken to a lot of their artists. The relationship that Spotify has with most of their artists is symbiotic. Whether they pay them enough is debatable and will always be debatable. But what is probably not debatable is this is a source of potential revenue for the artist. And I don't just mean 1 cent per listen or anything like that. It leads to tours. It leads to record sales. It leads to other business where the artists do quite well. So I'm not in the camp of people who are especially worried about it.
How can Spotify combat the record labels squeezing their margins?
Spotify needs to weaponize their user base. The recommendation algorithm, they can start promoting one label's music over a different label's music because a lot of users rely on the algorithm to find music. But yeah, it's like a symbiotic relationship. The record labels are codependent upon Spotify's revenue to support their business, and Spotify needs them definitely to run their business. It's not even about really expanding the leverage on the labels. It's about adding the other services where they can have higher margin products like podcasts where they have advertising. They can sell tickets to concerts. It's about the other things.
You would see now that a lot of these labels are selling their catalogs, or the artists are selling their catalogs to these big private equity players. I think a lot of big players are in now, and the relationship has to improve. There's no way these big funds, Apollo, KKR, even Blackstone, these guys are in there for squeeze Spotify, because I think 40-50% of the future, their revenue streams are driven or would be driven by Spotify alone. So there's no way they not improve the relationship or make it better than it is right now.
Pretty much every year, Spotify has to renegotiate its contract with one of the main record labels. How can Spotify perpetually defend its margins in these negotiations?
It's not going to be easy. This to me is the biggest dynamic for the company for an investor to understand. Warner, Sony, Universal, oligopoly of record labels. And it's been that way for a long period of time. They are fantastic operators and they are not ceding share to anyone. Anytime someone gets close, they crush them or they acquire them, pretty much. That makes it really tough for Spotify or for Apple or for Amazon or for NetEase or for Tencent or for YouTube to negotiate with them. And over the last 3 years, while Spotify's grown steadily, they've actually ceded a little bit of share, which gives them slightly less of a negotiating leverage than they would have if they were 50% share or 60% share. It's minimal, it's marginal, it's not a big deal, but it does make it harder for them to attain gross margin leverage, which is we do need to see as shareholders. That said, they are able to introduce new services. They're excited about the things that they're doing. They think they can get to 30-40% gross margins long term. Most of that's going to have to come from ancillary services, not from this core business. There's another interesting dynamic there that we need to think about, which is demographics. A large percent of their users now are younger, millennials, Gen Y, Gen Z, Gen X. As Spotify matures, as streaming matures, the demographics are going to spread out. And more of the library is going to come from existing music instead of new music. And so when it's coming from existing music, that is a better business for the labels. And it puts the artists in less of a position to negotiate content rights. And when you look at the entire industry and you ask yourself, what piece do I want to own? It's hard to invest in an artist. You can invest in a record label, or you can invest in the pipe, in this case, Spotify. As you look forward and you more content potentially coming out of existing libraries rather than new libraries, you might ask yourself, where would I rather be? And I don't know if the answer to that question is necessarily the pipe. It may actually be the library itself.
Which would you rather be, the artist, Spotify, or the labels?
Probably the artists in this case. They have a lot more flexibility in what they can monetize on each platform.
I would personally love to be Spotify. I love the product. I'm on it almost all the day working. From a power standpoint, I think it's great to be a label. They own all these libraries, catalogs, and assets. It's an oligopoly right now. 3 labels out there. I think they have a great power on this ecosystem, and it would be great to be one of them right now.
I think I want to be the label. I think we're seeing more avenues where music ends up. Just for example, Peloton spent $100 million last year on music rights. So there's more and more places where music's ending up and more opportunities to sell music.
When Spotify released earnings recently, they announced a change in their guidance cadence from 1 year to quarterly. What do you make of this change?
I don't really get it. They said that it's in an effort to pursue their long-term goals and not to get carried away with short-term goals, but they're still giving us quarterly numbers. So why not just give us a multi-year outlook and let the street sit and wallow? It's a little confusing to me. I think it's a recognition of just how difficult it is for them to forecast this business. We look at it as a subscription model, but there's some churn. It's not as sassy as we want it to be.
Spotify seems to be focusing more on ad revenue. Is there a precedent for this? And how will it affect margins?
Yeah, this is a tough business. I'm sure a few people remember Pandora, and Pandora had premium subs, and then they had ad-based members. The premium subs business was fantastic. It generated cash. It was profitable. It grew okay. It wasn't Spotify. Spotify's a juggernaut compared to them. So it's apples and oranges to some extent. But there is some precedent looking at Pandora's ad business. Broadly was unsuccessful. It's a different format. You need to have advertisers who are creating content in audio. They need to be creating content in audio that's 15 seconds or 5 seconds or 10 seconds or 20 seconds, because an audio streamer is not accustomed to listening to a 30 to 45 second spot. They're going to skip it. There is somewhat of a mismatch. There is a learning curve. It's a much harder business, and we haven't seen anyone get to real scale from a margin perspective to date. I do think part of the reason why in their last earnings call, they talked about tough margins ahead was that transition of, premium business is still growing, but it's decelerating, no question. The ad business is becoming a larger piece of their revenue, and that's going to be a lower margin business. And so it's just math that it carries a larger weight and it brings down overall business margins. Whether they can be the first to really scale it remains to be seen. If anyone can, it is probably Spotify.
So speaking of podcasts, why are podcasts strategically important to Spotify?
You can use the Netflix analogy here. I can see them following a similar playbook. You have to have your own content to have better economics, because music doesn't have good economics. So you pay out most of your revenues to artists and labels. So they need the podcast ecosystem to first have their own content so that they can attract more users. And I think they're already doing that right now with all these podcasts, Joe Rogan obviously being the biggest one in there. So you need to own content to be able to curate specific content for users and have a better recommendation engine. And also it's really important for them to be able to know more about the users, as weird as it sounds, but I think the more data they can have on the users with the help of these podcasts, the more buckets they can put them in. I think it's better for the advertisers advertising business as well, so that they can serve better user analytics to the advertisers. So I think it helps them in a lot of ways. Customer acquisition for sure, acquiring the different podcasts helps them own different and then good content, which is theirs. And I think it helps them in a lot of ways.
Why are podcasts strategically important to Spotify?
It's a fixed cost versus a variable cost in the music. So they gave Joe Rogan $100 million. Now it's a question of are they going to recoup that $100 million? It's on their own volition to monetize him most effectively. And that's why you can be bullish on them. They can learn about you, learn about your habits, your interests, and then serve you stronger ads.
You're betting, I think, that Spotify is able to compete with companies who use the same service as a free lead gen source, who aren't margin sensitive, and that Spotify is going to be able to launch ancillary services that make up for that margin difficulty.
Great. All right. And last, Pat, any Spotify predictions?
Yeah, it's tough to get like a read on what an inflection point in the business would really look like. So I really think the Spotify short term just kind of treads water a little bit. They make progress on their ancillary services like audiobooks, podcasts, all that stuff. But I mean, if music really is a commodity, I am a little nervous about a new player entering the space, someone with a really strong funnel, maybe someone named with Facebook. A little prediction, a little thing that makes me nervous. That's all.
I think they're probably going to move more aggressively to look a little bit more like a label. They're offering services to help launch new artists, to help launch new podcasts. It makes total sense. You know, Uday said it. Daniel Ek, he's the best in the business. And, you know, you get to hear him on podcasts, and you get to hear his interviews, and you get to listen to him on conference calls. Sharp as a tack. I mean, nothing but success so far in building this business, and they know what they need to do. And it's probably, you know, in order to expand margins, they probably need to look and act and feel a little bit more like a label.
Thanks so much for checking out Alpha Bets. If you enjoyed this discussion, please like this video and definitely check out our other discussions on Open Door, Corsair, Robinhood, and many more. Catch you next time.